Many people view the stock market as a chaotic arena where wealth is built or destroyed by chance. Looking at the blurred energy of traditional trading floors, it is easy to see why the gambling comparison is so common. But physical trading pits have largely been replaced. Beneath the surface noise, the modern market is a precise digital ecosystem following specific, predictable rules. This environment functions as a highly structured mechanical system, one that requires deconstruction to be understood. At its core is the share. When you buy a stock in company XYZ, you are legally acquiring a specific percentage of a functioning business. As the underlying company expands and thrives, the value of your ownership stake grows. You are quite literally tied to the success of the enterprise. The inverse is also true. If the company's performance declines, the value of your capital decreases accordingly. You extract profit from this relationship in two ways: by selling the appreciated share to someone else, or by receiving dividends, a direct cut of the company's profits paid to shareholders. Choosing to buy a stock is the act of acquiring fluctuating property. It is a decision based on the tangible value of a business. These shares change hands at a centralized location known as the stock exchange. Every price movement within this exchange is driven by the foundational logic of supply and demand. When buyers outnumber sellers, prices move up to find new sellers. When sellers outnumber buyers, prices drop to attract new interest. While supply and demand provide the energy, the modern market requires a digital ledger to execute these movements with total precision. This ledger is called the order book. It functions like a high-speed digital auction, recording every intent to buy or sell. On one side is the bid, exact prices buyers will pay. Opposing is the ask, higher prices owners demand to sell. The gap between them is the spread. Price only changes when a participant crosses the spread and accepts the other's price, moving the ticker. Prices do not move randomly. They shift because specific participants use their capital to force an order through the book. To understand the larger trends, we have to look at who controls the majority of the capital moving through the exchange. The market is dominated by institutional giants, massive banks and mutual funds that manage billions of dollars. These institutions are the great whales of the financial ecosystem. They move through the market with a scale that individual retail traders cannot match. Because of their immense size, their decisions physically dictate the currents and trends of the global market. Success for a retail trader involves identifying these institutional movements and learning to ride the wake they leave behind. The stock market only becomes a destructive casino for those who ignore these mechanics and trade based on guesswork. By applying the logic of ownership, the mechanics of the order book, and the path of institutional flow, a participant operates with measurable skill. Navigating this mechanical system requires more than just technical data. It demands the discipline to follow a proven system when the volatility created by those institutional whales starts testing your patience. These large players understand retail emotions perfectly, and they often use them to create traps within the order book. To learn how to identify these traps and master the realities of the market, follow Blackpearl Traders and prepare for Lesson 2.